And I think we all know that well-functioning financial markets are vital to everybody's interests. Yeah, they support businesses, they support growth, are very important, because actually without secondary markets, somebody investing in a primary market is, they're investing for 50 years or whatever. They're effectively investing only for the dividend flow. So without secondary markets that are efficient and function well, you're going to see real problems in primary markets supporting things such as building companies and so on. And one of the trends that we've seen over the last, I would guess 20 years roughly, is we've seen markets move from open outcry, human beings gathering in rooms and sort of looking at each other and going, yeah, I'll buy off you, through to, first of all, the electronification of markets and marketplaces, and then that once they were electronic, that whole process speeding up. And we've got to a point now where so-called high-frequency trading represents about a third of equity trading in the UK and about 60% of equity trading in the US. So the UK government committed on this. I'm one of the lead expert group. There were 6 of us, as Nigel has already said, on the lead expert group. There was also a high-level stakeholder group, and we're lucky to have some members of the high-level stakeholder group here tonight as well. The function of those 2 bits, the high-level stakeholder group gave us sort of guidance on, were we addressing the right issues and so on, and then the lead expert group, myself, Philip, and a few others, actually said, is the credible academic evidence out there that we can use and just read the report and say, yeah, this is credible, this guy knows what he's talking about, it's been properly reviewed, this is a suitable inclusion for our evidence base, or do we have to go and commission evidence to address that particular point? So what happened was, because of the increasing percentage of trading that was happening in a sort of computer-to-computer way, even before May 6, there was considerable interest at a sort of government level, and there were already talks going on about, should this be something where the government looked at the markets and just said, what's going on? Are there risks here? Is it a good thing? Is it a bad thing? We're already hearing people having a debate about HFT, and the debate about high-frequency trading has been very, very polarised. You seem to have almost 2 camps. You seem to have the one side who say, HFT, good. And you have the other side who say, HFT, bad. And that's been the depth quite often of the argument. You've got one group of people saying it's an unadulterated good, and another group saying it's an unadulterated evil. And so that obviously raised political interest and political concerns. And then on, of course, May 6th, we saw a crash which wiped literally $1 trillion off the value of the US equity markets, of US markets, in literally a matter of minutes. Fortunately, it bounced back, and most of that value came back, but it did nothing for the sort of faith that people had in markets and market infrastructures. Those sort of things continue to go on. This slide really illustrates the sort of number of mini flash crashes, so to speak, that we're seeing. Yet one of the sort of big concerns for all of this is that there's a lack of evidence and analysis on the impact that HFT has on markets. And that lack of evidence means that policymakers really are, or really were, operating somewhat in the dark. So what the UK government then did was commission our piece of work, which has proven to be one of the most comprehensive studies into computer-based trading to date. And it really addresses 2 critical challenges created by the relentless rise of computer-to-computer trading. Those challenges are, does it add something, and does it impact on financial stability? So is it something where we are exposing the system to unnecessary risks? And what the project has aimed to do is make the best available evidence available to policymakers in a way that they know the evidence has been vetted and they can trust that evidence. And it then aims to also make clear advice on what regulatory measures may be effective and what regulatory measures may not be effective. I'll talk about a couple of those later in the presentation, but to keep this in my allotted 20 minutes, we're not going to go through the whole of MiFID II or anything. Although if you read the report, and everybody's got a copy in front of them, it's 186 pages long. It's the work of about 150 scientists from 20 countries. We do actually, there's a chapter in there, I think it's chapter 6 or 7, but addresses most of the proposals which, when we were compiling the report, were there as policy suggestions for MiFID II. And what we found in the report was the key messages, really. The key messages were mixed. We didn't actually find a complete HFT evil, and we didn't find a complete HFT good. We found a message in between. So HFT does add some value, but there are some risks with it, and we'll talk about those in some of the subsequent slides. So just to sort of put into context the amount of work that was done and the process by which this happened. So all evidence, and this is, so we, as I said, we looked at evidence that already existed. The sort of test we used, if you will, to determine whether or not something went into the evidence base was what's called double-blind peer review. And that effectively means two people who don't know the author of a particular paper look at it, review it, and say, actually, does this stack up? Is it sensible? Is all the evidence high-quality evidence? And they review it and they say, yeah, this makes sense, or no, this doesn't make sense. And those were typically quite senior academics in institutions who have spent years and years looking at, in, for example, the market microstructure area, that particular area. And what we do for you to give you an idea of the work we actually commissioned. So if there was good quality work out there that we could rely on in a particular area, we obviously didn't go and commission more work just for the sake of it, because we were, after all, spending taxpayer dollars, or taxpayer pounds, I think, actually. But this is the evidence base that we actually commissioned directly ourselves, and that evidence base is available on the government's website, and people can go and download all of that, because one of the other important things was that any evidence we used has to be in the public domain. And we hope that the final report provides national and international policymakers the evidence that they need to continue their important work ensuring stable and competitive markets. So what did we actually find? So the first thing we found was that speed has always mattered to traders. Technology has always been increasing speed and reducing delays, and that in the past decade, trading technology has gone to superhuman. And what do we really mean by superhuman? We mean it's moved to the point where things are actually happening at a speed which is beyond the comprehension of us as human beings. So a human being takes about 150 milliseconds to notice something has actually changed. There are plenty of trades being done in times well below that at the moment. And one of the pieces of evidence that we commissioned suggested that there's now actually a two-phase market. So you've got market dynamics that are different in the computer-to-computer dynamic than in the computer-to-human dynamic. And as one of our other lead expert group members said, when he's talking about this particular slide, he says, what happened if you look back over the last 100, 200 years? We moved from traders who relied on horses to move them information about important news stories, through to pigeons, through to telephones, through to squawk boxes, and then electronic trading, and then co-location, and so on. And at some point we moved, in a similar way, we've moved from carbon-based organic life forms to silicon through to, now we're starting to look at even custom silicon and so on, FPGAs and stuff like that. And ultimately we've gone through a point where for certain phases of the markets, people are just too damn slow. We're made of the wrong stuff. Wiring neutrons, the things that are in our brains together is not the best way to solve some of these problems. So what trends did we see continuing? We thought that people are going to continue to use, or we're going to continue to see a growth in the use of custom silicon. And by custom silicon, we really mean FPGAs and similar products. So ASICs, if you're looking at a faster version of an FPGA. That was a trend that when we started the project, people were starting to talk about and use a little bit. We've seen a growth in from when Nigel and I first met, or not when we first met, when Nigel first introduced me to some of the senior guys at Intel, one of the questions they were asking was, what should we do with these multi-core processors that we're starting to see? At the time we were talking about multi-core, meaning 4, 8, 16 cores. Philip will now tell you that the number of cores that people have available on things like GPUs and so on is running into the thousands or tens of thousands of cores. So we've seen a move from multi-core to many-core, and we're seeing another move to the emergence of cloud computing and so on. And I think The key thing that I take away from all of this is actually not so much about any of the individual technologies, it's actually about the what you need to deploy those technologies. And one of the conversations Nigel and I had with the CTO of Intel at the time was, what should we do with all these cores? And the answer was, actually, the problem with all these cores is, if I'm running Excel or something, I Control-Alt-Delete on my box, I've got one busy core and 7 cores doing nothing. And that's because the tool sets aren't there to enable people to use these in a seamless way. To program well on a multi-core or many-core device, you've got to be a little bit of an expert in those devices. To use an FPGA well, you've got to be an expert in those devices. What we're starting to slowly see is there are better tools, and by tools I mean that in the sort of most generic way. It's either vendor companies pulling together these things into products that people can just use as a product, or it's vendor companies who are selling these technologies starting to produce tool sets that allow you to write a multi-core application with the same ease that you can currently write a single-core application. So that's one of the trends we expect to continue over the next 10 years or so. The other trends we expected to see in terms of consequences, we expect to see the depopulation of the trading floor continue. We expect to see barriers to entry continue to fall, and I think probably the most interesting one is we're starting to see the emergence of computer-optimized adaptive trading, or adaptive trading robots. And that actually has some quite profound implications for some of the MiFID recommendations. If the algorithms that people are using for trading are actually learning algorithms, the idea of tell me what my algorithm does before you put it into production, when you don't quite know because it may change itself, becomes kind of hard to enforce. And in the interest of brevity, I won't tell the joke about the dog, the trader, and the computer, as I'm sure we've all heard it before. So we then turn to look at the actual effects of computer-based trading, and primarily we mean high-frequency trading, on market quality. It's certainly controversial. One of the pieces of evidence we commissioned was an end-user study, and that end-user study divided people into groups, pretty much along the bad, good camp. The actual evidence base, however, suggests that it's had several beneficial effects. We found that liquidity has been improved, transaction costs have gone down, and price efficiency / price discovery has improved. We did this on the basis of data from the US market, from the EBS FX marketplace, from the Dutch market when Euronext started seeing competition from Chi-X, from London Stock Exchange data, from the French CAC, and this also lined up with the findings of various other governmental studies from Australia, Canada, and Sweden. But we also found, and this was, I think, one of the things that was reflecting the concerns in the study, in some of the surveys we had, that the buy side quite often have difficulty accessing liquidity. And that, again, comes back to the point of tools, which is the buy side need to get better tools to enable them to access that liquidity. We found that transaction fees, we found that transaction costs have definitely fallen. Most significantly, the introduction of Chi-X and BATS actually forced down clearing costs. Price efficiency has improved. We see that more trading tends to, unsurprisingly, deliver more efficient price discovery. We looked at liquidity, and we could see the evidence here was less strong, but we could see no clear link between intraday volatility and high-frequency trading. If you look at this is a measure of volatility on the vertical axis, time on the horizontal axis, and you can see the points where volatility was very high. Actually, there were fairly big external factors happening. So you look around 2008, 2009, there was this thing called Lehman's collapsing. I don't know if that had any impact on market volatility, but seemingly it did, because we can see that the evidence spikes up. Similarly, the sovereign debt crisis seems to have introduced another spike in volatility there. But what we saw in terms of volatility in periods where there wasn't some external event was generally, it seemed to be trending down. But as I said, the evidence wasn't very, very clear on any of that. So our sort of overall conclusion around that is that the nature of market making has changed. You've now got high-frequency traders, and this is really a byproduct of fragmentation, which was introduced in Europe, at least, around the time of MiFID I, partly as a result of MiFID I and partly as a result of firms such as Chi-X and BATs introducing competition to the existing national exchanges. And you're seeing that high-frequency traders are now providing the bulk of the liquidity in both futures and equities. So unlike the old designated specialists, these guys typically operate with very little capital or relatively little committed capital. They may have quite a lot of capital, but they don't commit it to their trading strategies. They tend to hold small inventory positions, and they have no obligation to provide liquidity during times of market stress. And this, along with that sort of two-phase market nature of the trading at a computer-to-computer level happening at a point where people can't look at it, provides an opportunity for periodic illiquidity. So within the computerized environment, and particularly in that sort of robot-to-robot phase, we found that there's the risk of mechanical feedback loops, most of which will wash out at lower frequencies. But here are some of the ones that are identified, and again, there's a lot more information in the report. You can see, for example, in the first scenario, you can see volatility causes widening bid-ask spreads, which causes further volatility. You can see in the second scenario, you can see percentage of volume algos creating the volume which they then track. Third one, you can see a thin capital base and a lack of willingness to lose it means HFTs become less active when markets are toxic, which again means that the market flow starts to look more toxic because the potential for adverse selection just rises and rises. These two scenarios over here are, effectively the portfolio hedge loop, and that same process of the index falling, you adjust your delta hedge, you sell some stocks as part of that delta hedge, therefore the index falls, was the underlying mechanism behind the flash crash, not the flash crash, the crash of 87, which certainly wasn't attributable to, it was attributable to computer models, but it wasn't attributable to computer-based trading. So the next two scenarios illustrate that. And the thing about market data slowing up, that causing prices to be displayed, causing sell orders to be routed to a particular venue, was one of the mechanisms that you see in the May 6th flash crash. But whilst a lot of those sort of trends do wash out in the shorter term, one of the things that it doesn't wash out in the longer term, one of the things that doesn't wash out in the longer term is the sort of significant welfare costs. So one of the things that we're definitely experiencing at the moment is you've got this loop where HFT intermediation substitutes speed for capital. That means that markets look more shallow. That means there's less common knowledge. That means that there's potentially, or there's at least the perception that there's more scope for market manipulation and there are weaker social norms. That leads to a loss of confidence, which leads to less shallow markets, which leads to less common knowledge, and so you can go round in that loop. And that's really one of the loops that we have to address as an industry, I would suggest. We have to restore trust through transparency, through the application of law where people are abusing markets, although we didn't find any clear evidence that they are, and through enabling the regulators and our industry to have the tools to do that. And some of the tools to do that include things such as standards, such as common timestamps. And the second thing that is you've got a sort of process called normalization of deviances that happens quite often in sort of engineering projects. So if you look at the Challenger shuttle failure, for example, what happened there was the shuttle was launched, things happened that were outside the normal operating manual, there was no immediate disaster, so people thought, okay, we'll extend the normal operating range a little bit. Launch it again, something else goes outside the normal operating range, we'll extend it a bit more, no disaster. Then all of a sudden you get the Challenger space shuttle disaster where it's outside that envelope. There are no alerts known because they could have aborted the mission earlier or could have changed their planning, but it was felt to be inside the normal operating envelope, so there was nothing catastrophic wrong, and fairly obviously to anybody who watched that event, there was something very badly wrong. And we've got that same sort of potential risk as well in what we're doing with computer-based trading. And one of the recommendations that we do make in the report is that we should try and learn from other industries which have a culture of safety engineering. So what do we actually recommend? And as I said, I've skipped quite a few slides in the interest of brevity. So some of the recommendations we make are we call for things to limit the scope for further markets, for potential market disturbances. We call for coordinated circuit breakers and possibly coordination of tick sizes. We talk for other mechanisms for managing, and we talk about the need for other mechanisms for managing the potential adverse side effects of CBT and HFT. One of the recommendations we make very strongly is for a shared common timestamp so that we can actually see what's happening. At the moment, there are equity platforms out there capable of turning a trade round in about 60, 70 microseconds, yet a lot of the data out there doesn't have any timestamp, certainly not synchronized timestamp, to that resolution. So it's impossible to say, unless you're actually listening to all of these feeds simultaneously, it's impossible to put together a record of what happened. We talk about the need for improved circuit breakers and order book coordination. We talk about the need for global coordination between regulatory measures so you avoid regulatory arbitrage. And as I said before, we talk about the need to learn lessons from other safety critical industries. And a lot of these mechanisms will make surveillance of financial markets easier. And I think that's important for helping recover trust. Some of the things we eliminate, and I won't go into it for any in any detail, we did suggest that minimum resting times would be a pretty bad idea, and we suggested some better ideas. We also talked about other things we need to do to better understand the effects of CBT. We suggested developing an overall operational process map, and that really is to try and guide regulators into areas they need to look at. So what we're looking at there is some of the downstream back office type effects and so on. And is there a way where we can highlight to regulators that there is either an excessive cost in a section of the industry because processing is very inefficient, or is there a risk to financial stability in that sector? And that's one of the recommendations they're taking forward. And we talked about the need for better evidence around this whole area. So we talked about having an ability to get better data into the hands of researchers so that we can get more quality academic evidence out there to say this is a good thing or this is a bad thing. And that's really the sort of last point on here.